All right. Thank you all for joining. Assalamu alaikum. I am going to quickly just take 30 seconds to introduce myself. My name is Nabil Syed. For those of you guys who don't know me, I'm a local real estate broker in the Metro Detroit area. I own the brokerage Amin Realty. We have a sister company called Omni Property Managers, as well as Fajr Fund. Fasi is my partner at Fajr Fund. And inshallah, today, what we're planning on discussing is how to actually get started with investing in Detroit rental properties. The goal and the focus of today is to truly keep it very simple. We're going to give real numbers and we're going to keep it extremely straightforward and realistic. All right. No hype involved. What we want to do is actually get into the nitty and gritty of different components when it comes to investing. Another thing for you guys to know is that, alhamdulillah, a lot of this information is, utilizable in other marketplaces. But we're focused on Detroit because this is where we see a lot of potential upside for investors and where we've been focused on in the recent years. All right. So today we're going to focus on three different strategies, guys. Okay. And not only three different strategies, but three ways to execute them. And then we're actually going to review three real deals that follow these three different strategies. Okay. Now, before we begin, what it's extremely important for us to all know is why Detroit? What makes it unique? What gives it, the potential? And why is today's webinar on that city itself? Some of you guys may know a little bit about Detroit already. Maybe you guys hear about it in the news. Maybe you guys see it online. Maybe you guys live here in this Metro Detroit area. So you've been in the area itself. But today we're going to talk about the three components that truly make it an investor haven. And those three things is scale, affordability, and access. Okay. So scale gives us the opportunity to do it over and over and grow. Affordability gives it easier entry to invest. And then access, meaning that there's lots of opportunities that are available as the city is coming back to life. The few things that I like to mention and for investors to truly understand is that Detroit is currently right now below the national replacement cost. And what I mean by that is that $100,000 or 1,000 square feet property, the cost to build it versus to buy either turnkey or buy it where you rehab it yourself is going to be significantly below what it costs to build a property that's similar. And a great opportunity for investors is the fact that the ownership market is truly fragmented. And this is a place where local relationships and being a cash buyer help you walk into the right deals. So we're going to talk about a few different metrics. These are not the only metrics that matter, but some of the most important metrics when it comes to investing. Population, land area, median gross rent, and median single family house price. Okay. So population is extremely important to understand not only just what the population is today, but what the population pattern is, right? So currently, the city of Detroit houses 650,000 residents. Just as a comparison, the city of Detroit, in the height of it, in the early 40s to late 50s, it even housed a total of 2 million people. And why I mention that is that it gives you the trajectory that it possibly has. We are less than a million. We can almost triple in population size, and Detroit has the infrastructure to support that kind of community. And in the last 3 years, we've seen consecutive population growth after 5 decades of a population decline. So, what that shows and tells is that homeowners, investors, and families are moving back into the city, right? Next is the land area. Detroit is the fifth largest city in the state of Michigan with 140 square miles. So, in terms of sheer size, it shows you the amount of opportunity that exists. The median gross rent is about $1,074, and the median single family house price is $90,000. For those of you guys who may have invested in the past or are familiar with real estate terminologies and underwriting tools, you guys will probably often hear something called the 1% rule, where if I buy a house for $100,000, at minimum, if my rent is $1,000, I should be in good shape. What we're going to do is talk a little bit about why that doesn't apply today. But even with that, premise in mind, you guys can see here that if the median rent is 1,074 and the purchase price is on average 90,000, we are above the 1% rule. Inshallah, we're not here to just focus on the average. We want to be above average. So our goal is that by the end of this webinar, you guys will have the knowledge to be able to get above median gross rents and below median single family house pricing during your acquisition. And hopefully by the end of this webinar, you will be able to answer this to yourself. Can you do it on your own? And can other realtors or investors even guide me? And the answer to both are yes, but with some caveats and some conditions. And we're going to help walk you through both of those options and how both of those opportunities and approaches basically look. All right. So we've talked about 3 different strategies, 3 different ways to do it. We're going to show you the full map of what things should look like in one slide. Okay. First, choose the proper strategy that works for you, your current, life and work, schedule, for your experience level, for your, affordability level. So many different things that truly, truly come into place when making this decision, right? How much time and how much money do you have, and how much risk are you willing to take? All right. So 3 ways that you can approach this is by doing it yourself. Okay. Second is using local help. That's hiring the right people, hiring the right realtors, hiring the real maintenance teams, the right property managers. And then third is portfolio level. I don't want to do anything. Here's my money. You guys are experienced. Go do it. So there's no right or wrong with either of these. It's just what I hope by the end of today is that you guys really have a clear picture of what the different approaches actually look like. All right. Now, at the top of the slide, you'll see that I put 3 different things: turnkey, add value, and BRRR. Has anyone heard of any of these 3 terminologies? If so, just in the group chat, I'd love for you guys to interact with me. Just put 1, 2, or 3, or one, or even all of them if you've heard them all, of which ones that you might be familiar with. And I'm going to continue on in case some of you guys answer, don't answer. Fasi, feel free to monitor. But all of these are truly and in fact completely different. And what a turnkey property is and means is that you're buying a finished product. This should be a property that's renovated. It should be already cash flowing, meaning that there's a tenant inside. And if it's not cash flowing, it should be ready for a tenant to actually come and live in that property. Add value is a property that needs some level of work. It's something that we don't consider to be a full rehab, but it will require some level of maintenance or renovation. And then BRRR is an acronym that stands for buy, renovate, rent, refinance, and repeat. You are creating the finished product. And unlike the add value, most of the time, it actually does require a full renovation. Okay. So we're going to now walk into how each of these look by doing it on the 3 different levels of approach that we mentioned. Okay. So doing it yourself with all of these will require you to find the deal. For turnkey properties, a good place and where a lot of investors are finding these types of deals is even on Zillow. It's not truly hard to find it. What's harder is to underwrite it and make sure that the deal makes sense for you. But once you find the deal, it's your job to make sure you inspect it and you know what you're buying and then managing that property. On the second level, By getting help, what you could do is hire a realtor, and their job is to negotiate for you, hopefully find you a better deal than you would be able to find yourself. And they would assist through referrals, or even if they have sister companies like ourselves, where they're helping lease it, manage it, maintain it, so on and so forth. And you still get to own the property directly. So you're the decision maker, you're just hiring the right people to help you. And at a portfolio level, what you're doing is actually investing in a company as a group of investors, trusting a general partner that could be someone like Fasi, it could be someone like Brother Omar here, who has the skills and the expertise. And you trust them by investing capital into the fund, and they are going out and buying turnkey properties and doing the verifying and the underwriting that we just talked about. Now, add value properties. Similarly, you're going to find the deal. But truly, if you want a property that makes sense, by finding the deal, you can't just limit yourself to the MLS or Zillow or other public search engines. Good deals are harder to come by. There's a lot of money to be made. But again, you make money when you buy the deal as well. And that goes for all of these properties. What you would need is to have access to potentially wholesalers, off market access. Maybe you're buying on auction, but in short, you've got to think outside of the box. Okay. Then you're repairing the property, you are leasing it yourself, and then similarly, you're managing it, and so on and so forth. In terms of local help, you can get a company to assist you with this. Their job is to source the deal and manage the maintenance or the updates that need to be done. And on a portfolio level, again, you are investing in a fund. One thing I'd like to mention here about funds, a pro side to it, is that in an example where you're investing $100,000 into one property yourself, you have all your $100,000 in that one property. On the second hand, by investing in a portfolio, you could still invest the same $100,000 and still get similar returns. But what you're doing is potentially investing that $100,000 across 10 properties. So it adds some level of risk mitigation. Okay. Next, we've talked about the BRRR. So just to remind you guys, it stands for buy, renovate, rent, refinance, and repeat. Okay. All of these have their pros and cons, which we're going to get into a little bit later. But again, you are buying the deal, you're getting construction bids, and hopefully making sure that you know your budgets even prior to close. When we say rehab, we're assuming that a lot of times the renovation might even cost more than the property. Just to give you an example number, you bought a property for $40,000 and you put $60,000 in construction in it. Now, yes, you get to do it the way you like. Hopefully and ideally that product is worth more by the end of it, but you've got to manage and handle everything from buying, rehabbing, renting, and then dealing with the financial aspect of going through the refinance. The second level is getting help. Again, you can get a company that will assist you with these different steps. Please make sure that you guys are vetting who you guys are working with. And then on a portfolio level, at manager's discretion, they may be doing this a part of their fund model as well. So again, these are the three different investment solutions that a lot of long-term investors are currently doing, that we can assist with all three of these. And hopefully by the end of it, you should have some level of understanding of what it takes to be able to even do this yourself. A simple rule for all of us to know and live by when it comes to investing. Some people want more control, which is fine, but keep in mind that more control often leads to a lot more responsibility. Less involvement, you're relying on operators and the people that you've hired. But you have less control, let's just say, as a comparison, right? But this is a very simple rule that will help you guys along the way in your decision-making process. Now, before I skip to this, any questions on any of the three options that I mentioned? Feel free to take a minute or two, unmute yourself, and ask before I move on to the next slide. Okay. All right, we're going to go ahead and continue to move on. Now, we've talked about the three different strategies and the three levels of involvement and ways to do it. Now, even more than that, as an investor, what you guys should need and be able to assess prior to making a commitment to any of these options is to understand the real risks, the actual time, and the money commitment that you need for any of these different strategies. And just to make it very clear, there is no good, bad, or better. Every one of us are in different positions. We have different time availability, different professions, different capital access. So I'm not here to give you guys any recommendation. Maybe in a later call, if you guys have more questions, we can start to narrow it down by answering some of your questions. But at the end of the day, all of these have their pros and cons. Now, turnkey, we're going to talk about the risks here. But before I give you guys the answer, I want you guys to put in the chat box which you think is the riskiest, one, two, or three. I'm going to give you guys 10 to 20 seconds to just go ahead and do that. Someone answered three. Okay. Another answer for three. All right. BRRR, that's three. Someone says one and three. Okay. Thank you guys for engaging. So a lot of you guys, alhamdulillah, are all on the right track. You've got it right. The BRRR, which is the third one, is the highest risk. Turnkey has the least. Add value is in between at medium. And we're going to, of course, go into a little bit more detail about it. But I hope that from the previous slides, you guys have a good understanding of why these are low, medium to high and what differentiates them. Now, more than just risk, we have to factor in all of the variables. And something that we can never get back is actually our time. For some of us, time is more valuable than it might be for a 22-year-old or a 23-year-old or someone who has a little bit more runway to try to get things right. So time is a huge factor, and it's a lot more different for each of these. But turnkey is low. It doesn't really require much involvement, and ideally you want it cash flowing from day one. Add value is medium. You probably will have to do some repairs, rent it yourself, so on and so forth, but it's not a full rehab. And BRRR requires a lot more intensive construction, then renting, and then actually executing the financial aspect of it. Now, cash needed, turnkey and add value are at medium. Turnkey properties can be bought with financing. There are both traditional and Islamic finance companies that will help you buy an investment property. And, you can also buy these cash, but of course, medium because of the fact that there is a finance option. Add value, also medium. Sometimes you're even able to buy an add value property with traditional financing, and then you might need to actually do some of the upgrades in cash. Or second, some things that we've seen investors do out of the box thinking, where they buy the property cash and they might open up a new credit card that's interest free for 12 months or X amount of time, and then they're financing some of the repairs because it's not so extensive. You might have a credit card limit that would be able to help you with that. And then BRRR is high because most likely you need to buy the property full cash, and then you also need to do the full renovation cash. Now, are there hard money lenders and so on and so forth? Yes, but I would extremely urge you guys to stay away because at the end of the day, the rates are high, the fees, the points, all of that really truly kills a lot of good deals that a lot of people have gone with hard money lenders that ended up not being nearly what they anticipated. Now, all of these have different risk levels, but similarly, guys, have you guys heard the saying, high risk, high reward? If so, just know it's a true saying. But keep in mind, there is that risk, and you need to answer for yourself at what risk, tolerance are you in at your current stage today. Turnkey is a lot lower. Add value, medium. BRRR is the highest. And your role as the investor truly changes depending on what type of investment you're doing. And we're going to explain what your main job should be with all three of these strategies. Okay. For turnkey properties, it's simple. You need to verify before buying. And we're actually going to go through the exercise, and we're going to give you the underwriting tools that we use as a company ourselves. So hopefully by the end of it, inshallah, you will be able to get the skills needed to be able to verify what you're buying. Second, when it comes to add value, the real risk and the main concern that you should have, of course, you're still verifying before. All of these things will require everything, that's coming prior to it. But the main goal is to control the repairs and make sure that things are within budget and are being done right. With BRRR, it's the complete execution of things. It's a lot more extensive of a rehab, and then making sure that the property appraises, your refinance terms make sense, and that after the execution of the refinance is done, you're still cash flowing. In short, the more value you create for yourself, the more execution risk you accept. This is why underwriting and the people you choose to work with matter more than the headline return. I've had many instances where investors, they buy through other people. It could be a family, it could be a friend, it could be just someone they found online, and they sell you an investment where it looks great on paper, but then they go wrong with the underwriting because they didn't know the things to look for, or they end up buying a great deal, but they hire the wrong manager or the wrong maintenance team, or they put in the wrong tenant, and that really kills the deal. They get a bad taste in their mouth and they no longer want anything to do with real estate. Our goal today is to save you that heartache and hopefully teach you things that we had to learn, unfortunately, the hard way. Now, a lot of times, why this happens is that people think that if I just buy a cheap house, right, that I'll be fine. Like, how bad can it be if I'm buying an $80,000 house that's being rented for $1,100? But just because it's cheap does not automatically work. Detroit does come with its own risks, potential break-ins, a little bit more crime in the area. You also have lower income tenants. So all these things need to be taken into account. Of course, there is a lot of upside with taking some of that risk, but just buying a cheap house is not going to work. Truly understanding where you're buying, how you're buying, all that is going to factor in. When you guys buy a turnkey rental, the numbers can't be the only thing that you guys look at. You guys need to look at the block. Make sure that it doesn't have a lot of vacancies or abandoned properties. Some of the things that we like to do is look for brick properties or neighborhoods that are starting to have a lot more renovations happen on that street. Then tenant demand, and doing some market research to see if this will have good positive resale value in the coming years. So again, these are the things that you need to look for when buying a turnkey property. When buying an add value property, buying it for the right price is the thing that matters the most. Second is controlling the rehab and the upkeep that needs to be done. And then the holding cost. I specifically put holding cost here because sometimes you think you have a great deal, like you're buying a property, you're expecting I'm going to fix it up, and it takes, instead of the 3 months you planned, 8 months, and then it took 2 months more to find the right tenant. In that 1 year of loss that you had in expense, maybe a turnkey property would have been a better fit for you. But again, as long as you're able to control those holding costs and plan for these things and have contingencies, you should be in a good position. Just make sure that you guys know your numbers and you plan B, you plan C, plan D, and make sure that, when things get hard, you have people to rely on and ways to pivot. And then, with the BRRRR model, again, execution, contractors, very extremely difficult to manage, keep timelines for, so on and so forth. But then it's the leasing and the management. Okay. So as long as you guys understand what it is that you guys are getting into, you guys will be able to make good and smart investment decisions. Now, before we begin, because the next slide is going to give you guys a real look of what investment properties actually look like, does anyone have any questions about anything that was mentioned so far? Feel free to unmute yourself or type in the chat. Okay,
If I may
we're
ask
going to go
a
ahead.
question, Nabil.
Yes, Brother Suhail?
Yes, regarding the BRRRR and the turnkey, you mentioned that the cash required for BRRR is much higher than turnkey. Do you mind elaborating on that a bit? If you did, I apologize if I missed.
No worries. So, in short, with turnkey properties, because they are livable and they are already cash flowing, a lot of times people can get financing for it. So, let's say, for example, $100,000 house, a bank might only require you to put $20,000 down, which is 20%, and you can also, for example, even get some seller finance or seller concession or down payment assistance. There's these different things. So in short, you could buy $100,000 turnkey property for maybe as low as $20,000 invested versus a BRRR property that $100,000 will pretty much need to be 100% cash. One, you have to buy the property cash because you can't get financing on it because it's not in livable or financeable condition. And then second, because of the size of the construction, even trying to do things like using credit cards and whatnot might not be sufficient. So you're spending the full $100,000 cash out of your pocket.
Got it. Jazakallah khair. Thank you.
Well, yuck. So now we're going to move on to the next slide, guys. This is where I really want you guys to pay attention. And one rule of thumb that I personally live by, I don't like to just listen, I like to actually do. And we're going to give you guys an opportunity to go through these exercises with us. So, first thing you guys are going to see here in the group chat, in the chat box, is a link to a drive for a real ROI calculator that we use live, we use today, pretty much on a daily basis to underwrite some of our deals. It's simple, easy enough to understand, but I would really recommend that every one of us open this slide. And then second, Brother Fasi, if you can drop the link to the property, you'll see that this address here is a real property. You guys can see the pictures, the details, so on and so forth. All right. Now, hopefully you guys have that open. Okay. In this property is a turnkey occupied property that is being bought for 72.5K. Okay. Currently, today, it is rented at $1,050 a month and is already cash flowing. The timeline 0 to 30 days, but it's 0 days since it's already having a tenant in there. All right. Now, what's happening here is that you're buying a property for about $74,000 all in. We put closing costs and purchase price. You're getting an annual rent of 13K. The exercise that I want to do together with you guys is to calculate the cash on cash return. Okay. And before I switch to that slide, what I'm going to do is I'm going to also put in the details with you guys live. Okay. So you guys can see my Excel
Just a quick
here.
suggestion, guys. I think I don't want everybody editing the same Excel sheet, so feel free to make copies of this. You can go to File and or make a copy so that you guys have this calculator. It is going to be a great tool for you guys to use later on.
Correct. So again, we're going to put the purchase price here, $72,500. Okay. This should equal to, okay. You guys can see it's not only calculating the cash, but the mortgage column as well. All right. Rent for this property is $1,050.
Maybe, do you want to also look at the property itself, the pictures? Maybe just
Yes. You know what? You're absolutely right. Let's go ahead and do that. All right. So you guys can see for 72.5, it's a brick property, about 800 square feet. Generally updated, has wood floor, fresh paint throughout. It's one of the bedrooms. Bathroom is older, but you do see new vanity, new toilets, new mirrors. Kitchen has vinyl flooring, older cabinets. It does have a half bathroom in the basement as well. Some newer mechanicals. Basements are freshly painted. Walls. You guys can see the backyard. It has a central AC system. It also has basically a sunroom. This is the layout of the property. And then we're going to go back to the ROI sheet. Okay. So 72,500, $1,050. The property taxes on this, if you guys were to just simply buy the LLC that currently owns it, which would reduce the tax implications on it, which is what we would recommend, it would be about $1,500 in taxes. We're going to underwrite the insurance at $1,200, which is about $100 a month. Sometimes it's a little bit lower, but I'm going to put $1,200 just to be a little bit more conservative on the ROI. We do factor in where this is where a lot of people make mistakes, is that they actually don't factor in anything for maintenance or vacancy. Even though it is occupied and cash flowing, we're still putting a 5% consideration for vacancy, because maybe 6 months or a year down the line, the tenant will leave and we'll have a little bit of vacancy for us to reoccupy that property. Then we've got the management fee, which is 10%. This is where if you were to hire someone, you would be able to completely offload most of the responsibilities. Utilities, trash, landscaping, and snow removal is all the tenant's responsibility, which is one thing that I love about single family houses. And long story short, even with $1,050 as the gross rent, you'll notice that the cash flow at the end of every month is about $615. And when you calculate it as a cash on cash ROI, which is basically taking this rental return per year after subtracting all these costs with the total of your purchase price and your closing costs, you're at about 10%. Similarly, on a mortgage, we have all the same components, except we do have a mortgage rate here where we've put in about 7.5 for today's rates, which is pretty in line with what investors will have to pay. You see that your return as a cash flow per month in a dollar form goes down significantly, $230, but your ROI as a percentage does shoot up. And it's simply due to the fact that you're only putting 20% down versus this full cash amount. Now, both have their pros and cons. For example, on a cash flowing property that's completely owned by cash, there's a lot less risk involved. Mortgage, God forbid, tenant leaves, you are now paying that 1 or 2 months of mortgage out of your pocket. So all these things are to take into consideration. Now, which one is better for you? It truly depends on your situation. Okay? So, any questions here about the exercise that we just did? And hopefully you guys can see that once you guys go through it a few times, it really will be like, just doing something that you do on a regular day basis. Brother Imran, I see that you've raised your hand.
Yeah, I had a question. So, I saw it takes like 360 months to make it back. On top,
No,
right? G.
this would be the term of the mortgage. It would be a 30-year loan, not how many
Okay.
months it takes to make it back.
How long would it take to make the cost back, like
So
your
in
your
this
investment back?
mortgage formula at 16%, you're looking at about 6 years, right? On a cash on cash of 10%, you're making about you're making all your cash back within 10 years. Now, this is still not factoring in the appreciation that the property actually goes up in value, and you have another, added return there, and not to mention also some additional tax benefits. So if we were to consider all of that, it might be a lot more than that. But in simple layman terms, cash on cash, 10 years if you buy it all cash, and about 6 years if you buy it with mortgage.
Do you have a projected value for the next 5 years?
So what we're using currently for our underwriting mechanism is about 3% as a reserved underwriting appreciation. Just so you guys are aware, for the last 4 years consecutively, Detroit has appreciated of 8% on average, which has been one of the highest across the nation and has been top 10 for the last 5 years, including being number 1 in 2023. But again, what we'd like to do is for you guys to anticipate lower, and if it works out a lot better in your favor, alhamdulillah.
There's another question by Brother Syed. Go ahead.
Brother Syed, please feel free to unmute yourself. If you're saying something, we can't hear you just yet. Brother Syed, if
Okay,
you're
sorry about that.
we can hear you now.
I have a question related to the mortgage. Maybe that'll be covered in the future slides. But just wanted to
Yes.
quickly ask, are there Islamic financing companies or the mortgage companies that offer this low-cost mortgages?
Yeah, there is. It might have a threshold. Like last I spoke to guidance in residential, I believe it was a minimum of 65K. So this example might be just under. I'm not 100% sure, but yes, I have closed deals with people using, companies like Guidance as well as UIF.
Okay. Jazakallah.
Yep.
Thank you.
Brother Imran, did you have another question?
Yeah. So I know you've been doing this for a couple of years. Have you noticed a certain area in Detroit, either East Side, is it Indian Village or something like that, where you've noticed the most appreciation?
Yeah, places like Indian Village, East Village, Boston Edison, those will have significantly more appreciation, but they are in higher price points, 2, 3, 4, 500K. And if you're hoping for that type of investment to work out as a rental, 9 out of 10 chance it won't.
Got you. Okay. What have you seen work out successfully from 5 years ago, 2021 to now 2026?
So there are certain zip codes, but in short, areas like 48234, 48224, 48212, these are all East Side zip codes. There are areas like 48206, but there are areas where you can still buy between 80 to 100K turnkey properties, add value, so on and so forth, and get good yield. And that changes, right? We will, inshallah, with this being a part 2 of today's trading, is go into a market research webinar with you guys, inshallah, next. So hopefully I can answer a lot more questions, but just to give you some zip codes that we like the property in Varho, St. Aubin, it's in 48234. All right.
Thanks.
So the lesson for this type of deal is that the money was made at the acquisition, and the risks that you should really look for are making sure that it's a good tenant and that there's not any major cost that's coming in the coming years. So don't just judge a deal by the purchase price, judge it by the total basis, rent value, timeline, and risk. Now, again, this was a turnkey property. We are going to go to the next property. This is in 48212, okay? We're going to drop the link to this property as well. And I'm also going to show the numbers in the calculator. Nope. All right, Fasi, if you drop the link, I'll use that one as well. Varho link, right? Okay, cool. So Varho is a add value, okay? So a good amount of work was done to this property, but it wasn't a full rehab. Similarly, it has an exterior brick. It's a ranch, 3-bedroom, 1 bath, almost 1,000 square feet, okay? This is the interior. You guys can see we've done recessed lighting, some newer windows, doors. We've done flooring, new cabinets in the kitchen as well. You can see we went with quartz countertops. The mechanicals are older and needed some work that was done. You guys can see very nice property, currently for sale at 82.5. Bathroom, it was in decent shape. We kept the backsplash. We did flooring, new fixtures, tiles, vanities, you name it. You guys can see there's some landscaping work done, but there's leftover concrete. But again, this is a add value opportunity, right? And I'm going to quickly go back to the details. Actually, let me go back here. So we bought the property for 29K, and this was bought through auction. And we ended up spending about, actually, I think we put the wrong number. We spent a little bit more with holding costs and all, but it's about 58K all in. Okay. And we're currently renting this property for 1,200 a month. Sorry about not updating the numbers. We verified it just prior to the webinar, but about 58,000 invested. Okay. And output, we're going to go over, but what I'd like for you guys to see, it does take a 6-month timeline sometimes, 4 to 6 months. I believe this one might have took 5 months. And annual rent created is 14K. There's also about 20-ish K in equity. Now, what we want to do is look at the cash on cash return for this, right? And then again, once we do look at it, we're going to look over the lesson, which is it's in the middle. It's a lot of work in the sense that enough that needs to be done to create value. The main risks are the repair overruns and then rent assumptions. Maybe we won't rent it for 1,200. Maybe the 20K turns to 30K, and that truly changes your numbers a lot. I'm going to quickly show what this property looks like in terms of the details. We bought it for 29K, and then you can see, so this would probably be about $1,100. The repairs, 20K. Whoops. So, you know what? I know it's 58. I'm going to quickly look at my internal sheet to see this one. Just give me a second, guys. Yeah. So what happened on this property is that we did have overruns on the repairs. Oh, not 280,000, but it went about $8,000 over what we anticipated. So we've got about 58 grand into the property with closing cost and all. Rent is about 1,200. Taxes are similar. Insurance is similar. But you guys can see, because we took the risk and we did the add value, right? That the repair, by doing the repair, the cash on cash return went a lot higher, 15.17%. I'm going to put the repairs here as well. If you guys were to buy this property with a mortgage, which you guys really wouldn't because it's just too low of a minimum, maybe you guys could finance the repairs. But just looking at it as a traditional mortgage aspect, you might be at 20% return doing this with some financing or some leveraging involved. Okay? Any questions here, guys? All right. If no questions, we're going to move on. Again, this deal cannot be judged by just the purchase price. Judge it by the total basis, rent, value, timeline, and risk. For all of you guys, just to kind of give you guys some level of my experience, I've been doing real estate for the last 10 years. I've done over 100 renovation projects. We've deployed and managed over $15 million in assets. But even this property, we initially thought it would be about 20 grand to rehab. We spent 28K. And it's not that, you know what, you sometimes make a mistake. It's just that sometimes things cannot be seen until you actually begin working on the property. All right. Now, this next property here, Devonshire, this is a perfect BRRRR property. Now, we as a company don't do financing or leverage. But again, we do like to have all of our options available, especially for those of you guys who might be investing yourselves. We want you guys to be aware. But Fasi, if you can drop that one in the chat as well. Devonshire, all right. So Devonshire, property that was bought with $37,000. We ended up spending $57,000 in rehab. About 98K all in, 1,500 a month, 6 to 9 months timeline, and you know you've got contingencies that need to be taken into consideration. Annual rent is 18K. There is a good amount of equity created, being that the after renovation value is about 140-ish thousand, give or take some, and then cash on cash return. That's something that we're going to look into. This is construction and financing. It's not just buying real estate anymore. You're getting now into the construction business and the financial business as well. The main risks is that construction costs can go higher, the appraisal doesn't come in where you want it to, or in terms of refinance, sometimes your affordability versus rates and terms doesn't make sense. So now you've got all your cash in the deal, or you're not able to actually execute a proper refinance. Okay. Now, this deal, I'm going to quickly show. Oh, I think my screen stopped sharing. Oh, no. Is it sharing? One second, guys. Okay. All right. So this property, just to reiterate, deal was bought for about 37,000. Okay. We put, how much did we say, guys? 57,000 in. We're renting at 1,500. I would say the taxes will assess a little bit higher here, somewhere around 2,500. Insurance will be roughly the same. Now, when you look at it in terms of return, it's only 11%. But by refinancing and pulling out, what that strategy, the main focus is to get back out the capital that I have in the deal. If you were to do that and you just now have 20% equity into it, you have all your capital back. The property, let's say it appraises at 135,000 as an example, right? On $135,000, on $135,000, you've got about 27K into it. Some banks will give you up to 80% loan to value, meaning that if it's 135,000, they'll let you pull out about 80% of your capital. Your closing costs here would go down a little bit because it's a higher price point. No more renovation cost. Rates there. Okay. So what I want to highlight is that by pulling out your equity, your return in terms of the cash that's technically in the deal as an equity, your numbers go down a lot low in terms of cash flow. But what you're able to do is now recycle that capital and put it back into another deal. So you've, in short, started your property all cash, pulled out all your equity, you still own the property, you now have your cash free to go invest in another deal, and you're still making about $170 a month after factoring in all the costs and whatnot. And then there's still potential appreciation and so on and so forth. So to each deal, it has its own pros and cons. And again, none of them is better than the other. It just truly depends on what it is that you prefer and in what position you're in. All right. So the house may look simple, but the business behind it is different. The hardest part when it comes to turnkey properties, like we talked about, is really verifying the tenant. And there's not much equity. There is equity, but not much equity at close. Okay. Now, another thing that's very important to, again, reiterate is the timeline. 0 days of involvement, really. Varho, which was the turnkey or the add value opportunity we mentioned, that takes about 4 to 6 months. Devonshire took about 9 months, to be very frank, but usually a BRRRR will take anywhere between 6 to 9 months. Management involvement, St. Aubin, very limited. Varho, medium. Devonshire, high. Now, again, like we mentioned, with the medium, with the highs, there is some pros and cons to it. One being the involvement and the risk factor. But you guys can see here that we've shown equity created. This is also very important for long term, right? So some of these will create more equity. The rental returns are different depending on the strategy. All in, your amounts look different as well. And these are real numbers, projects that we've all done ourselves. And again, all of these properties make sense in their own way. Okay? Any questions on this so far, guys?
Can you go over control rehab again?
What did you say?
Can you go over control rehab again?
So control rehab means basically you're not doing a full construction job. You're not completely remodeling it, but it's your job to verify what's needed. And by controlling the rehab, what we're telling you guys to focus on is making sure that you're staying within a certain budget. Because in a scenario like recently, I actually just had a client who bought a house for about $30,000 all in. Now, he was assuming that he could now do the construction, or he knows people, he's local. Let me do the rehab myself. So he thought he could do it within about 20, maybe 25K. It ended up costing him a total of $35,000. He's about $65,000 into the property, but the rehab budget went $15,000 over. Now, at the end of the day, just to kind of preface it here, he has walked away from the deal still a winner because now it is successfully rented. But instead of it taking 4 months like he anticipated, it took him about 8 months and a lot of stress because he tried to find and now had to get more capital. He wasn't ready for that. So in short, your focus is to make sure that your budgets match what really needs to be done. Any other questions, team? Okay, moving on to the next slide. Now, all of these returns depend on how long you hold it. What I'd like to mention here is that even though there's equity created, when you really look at it over 5 to 10 years, high chances that these properties are going to have very similar or reasonably, within range of each other returns. Of course, the ad value is a little bit more. The BRRR might be a little bit more if you take on the risk, but over a 5-year period, traditionally, it ends up being very close to, what each of these are. And it's very important not to just go with the flashiest strategy. The goal is to pick the strategy that you can execute. I've had many people who've done, for their first deal, they went straight to wanting to do a BRRR and it didn't go according to plan. And they're like, Nabil, I wish I would have just started with a turnkey, and so on and so forth, right? So really the goal is to make sure that you're able to execute on these deals, right? Now, how to underwrite the deals. We wanted to give you like a very simple high school version. Total basis means the amount you're purchasing it for, plus closing, plus rehab, plus closing cost. Real rent, use supportable rent, not the best case rent, right? For example, if you see some that are renting for $1,300-$1,400, still maybe underwrite for $1,200 and see if it pencils out. Real expenses, tax, insurance, vacancies, repairs, and management, whichever of these are applicable. Usually all of them are. Value check, can I sell it, refinance, or am I holding it? What are the end goals? What is the exit strategy? And then failure test, what if rent is lower or rehab is higher? That's what we call stress testing. Instead of the $1,300 we assumed, does it make sense if it goes for $1,100? If the rehab I thought was $40,000 ends up going for $55,000, right? So these stress tests are very important for us to all do on our own. If the deal only works when things go perfectly, guys, don't go with that deal. That means it is not the deal for you. There must be something wrong, or there's too many things that need to get in a row for it to actually work out. Now, good operators start with one question, and before it's how much can I make, it is what can go wrong, okay? If you start with this, you will save yourself from headache. These are the different things: wrong blocks, missed repairs, rents too high, bad contractors, weak management. Look at all these components and truly ask the right questions. One, to yourself, of how much you can do yourself. And second, if I'm hiring people, what is their experience level? What is their track record? So on and so forth. Our standard, the deal should have more than one way to win. I don't need to always just rent it out. In a couple of years, I can sell it and make profit. Even if I don't sell it for more in 5 years, the 5 years that I held it, the cash flow needs to be high enough where it makes sense. And again, different variables, but in short, there cannot be just one exit strategy. Hold for rent, sell if pricing is strong, refinance only if the math still cash flows. I've had many situations where people did refinance. They pulled out all their money, but then they had to sell the property because they weren't able to manage their financials, pay the mortgage, keep money in their pocket. They went underwater in terms of the monthly payment. Now, for you guys, the decision is really matching something with your time, skill set, and risk comfort. Control means that you do it yourself and you get to make every decision. Support, own it, but get local help. You own the property, but use the people who have market knowledge. Portfolio is diversification, where you're completely hands off. You don't necessarily have time involved, but you give up control and it reduces broader exposure and manager execution because you're working with professionals. Again, I've iterated this multiple times. There is no perfect answer. There is the only answer of which you can execute well. The right strategy does not have the biggest headline return on paper. It doesn't sound the fanciest or sound the most lucrative. It is the one where you truly understand and is working for you, has the risk variables in place and the math makes sense. And really, bottom line is you guys truly need to understand it. One thing that I steer away from is investing in things that I don't understand, like stocks, for example. Sometimes I may dabble in it a little bit, but I don't know what's controlling the value to go up and down, and I don't have enough experience, so I try to stay away from it as much as possible. And when I do invest, I get help from the people who do understand that. So even if you guys are investing in a fund or getting support, you guys should be able to, at minimum, at least make sure who you're working with is capable. Bottom line, final takeaway, everything out of it that we've talked about, what you guys should understand is that Detroit is rewarding, but it requires discipline, not excitement, not cheap prices, not perfect perfect spreadsheets. It's buying right, repairing it right, renting it right, managing it right. And yes, on the first one, it might seem like a lot. It's a learning curve, but I promise you guys, this does get easier, just like riding a bike or swimming or anything that you guys have already done. It gets better, it gets easier. And this is why, personally, I have started myself as an investor buying turnkey rentals. Even though this is my profession, this is what I do, I did not want to bite off more than I can chew. So again, start slow, start with the ones that you think is most comfortable, depending on your risk appetite. And again, very simply, just as a disclaimer, not, financial, legal, tax, or investment advice. This is educational only. What I love to do and I have a passion for is helping others not make the same mistakes that I've made. And now I'd like to open it up one more time before questions, or any questions, anything that comes to mind.
Can you go back to the 3 properties?
Yep. Let me quickly go back. Okay.
The top one, how much would the down payment be?
So on a property like this, 20% plus closing cost, 74.5 times 0.2 plus another 5, about 20,000 all in to be able to buy something like that with financing.
Okay.
Any other questions?
No.
All right. All right. And now to share a little bit about how we can help you guys. These are the things that we can do. We can help you guys find the right asset. We can provide resources for proper tax planning, help you purchase, maintain, and sell the asset. And then we do have solutions for debt-free investing and passive income. Now, recently, with a new partnership that we've made, we also have potential opportunity for you guys to invest with even as low as $5,000 or $10,000 into an investment. Now, I don't want to go into too many details about that, but if you guys are interested in even being a shareholder in an investment property through a strategy like that, please do reach out and we can talk about it later. Why us? Just to give you a little bit about of our sister companies, Amin Realty sister, which is our main brokerage, 10 years plus operating, $1 billion in activity and deals closed, over 100 agents. We focus on deal flow, seller access, market intelligence, Omni property managers, leasing, maintenance, rehab, 90 doors plus managed, over 100 construction jobs complete. We do have our Fajr Income Fund as well, that not only does all the two things mentioned above through those umbrellas and arms, but we do capital reporting, so on and so forth. We've already deployed $2 million with a $10 million target for our next fund. Feel free to connect with us, and I'm looking forward to seeing you guys in the next webinars, inshallah. Hopefully, either next Thursday or sometime during the week, we will schedule part 2 of this with market research. Jazakallah for your guys' time. Assalamu alaikum wa rahmatullah. Anything to add here, brother Fasi?
No, I think you covered everything. Thank you very much, everybody. Do make sure to follow us on Instagram, Facebook, and other social media platforms, and keep an eye out for our next webinars. And we are happy to take any suggestions. If you guys want us to deep dive into any particular topics that you guys want to learn, we can definitely do that. Go ahead, brother Asad, you have a question?
Yeah, assalamu alaikum. I have some properties in Detroit already that basically were bought cash, and we're trying to stay away from financing, but it is getting harder. Don't have unlimited cash, so you guys have, like, I think you mentioned there's halal options for financing, right? So I definitely want to see that, I guess, in the next meeting, a little more about the financing options, if possible. Also, at the end, you mentioned that you guys do property management also.
We do.
Can I talk to you about that? I guess offline or something, just for property that we have.
Absolutely. So you can see here my partner, Brother Fasi's number, 313-782-2395. Feel free to text him, or even just go to our website, omnipropertymanagers.com. And then we have your contact as well. We'll reach out to you tomorrow and schedule a time to discuss.
All right, cool. Thank you so much.
Anything else, gentlemen? All right. Assalamu alaikum, and please enjoy the rest of your day. Those of you in Michigan, please stay out of, stay inside as much as possible, as we have some pretty bad air at this moment. Assalamu alaikum.
Assalamu alaikum.
Alaikum assalam wa rahmatullah. Jazakumullah khair.